Hello, everyone. Welcome to another edition of Vine Edition, and I've got Mr. Oscar Torres, partner at Bateman MacKay, one of our preferred accounting firms, and overall really cool guy. Oscar, thanks for joining us, man. Appreciate it.
Yeah, Hugo. I'm glad to be here. Thank you for inviting
Um,
me.
I have to say, we're currently recording this mid-April, and I was surprised that you were able to sort of peel away just a couple moments to chat because I know you guys are extremely busy with tax season, throughout the year, but more particularly around this time of the year. So I really appreciate your time. I think it's very timely to get a couple interesting points that we're seeing to some of the clients as they kind of go and start wrapping up their personal taxes, or perhaps as they start looking at corporate taxes. So again, I appreciate you being here, man.
Yeah, absolutely.
So I had a couple questions that come up, from clients that maybe you can touch on and shed a little light. So the first one that we're seeing is this idea of the underused housing tax. Like, how does that look like, and where do you see an impact on your end?
Oh, absolutely. That one has been a big one right now because this is a new kind of tax that came out. There is no backup in the Income Tax Act or anything to bring this in. The government is just basically doing it, to be honest, to go after foreign investors, right? So this
Yeah, yeah,
underused home tax really it affects you. There's a lot of criteria you can read upon it, but realistically, you really need to talk to your advisor if you have properties within a corporation or if you have it within a family trust or within a partnership, because that's exactly what this is trying to discover, this underused home tax, right? So
hmm
if you have these properties, there's a form that you need to file. And we have been doing this a lot for clients to the point that there was a deadline that the CRA had already set, but they have extended it. So what they're saying is, yeah, the deadline is still April 30th, but we're going to allow you to file this form a little bit late with not charging penalties and interest. So very important for people that have this type of properties in a corporation, and a lot of people do that. I have a lot of clients that do have properties in a corporation or in a family trust or partnership. So um, it's very good to have the conversation with the advisor, especially if you have a multifamily or if you have a building. I have clients that have some buildings, so the challenging part is that you have to file one per unit. So it takes some
yeah.
time to get all this done. So very important to at least
So
have some
don't
knowledge
forget,
about this. Yeah.
file it. It's new, so be aware of it. Another thing that we see quite a bit is just house flipping. Like what's kind of, a lot of people feel like they can go into a market, uh, purchase a property, put a little bit of money into it, quickly flip it, and will say, I made X amount. But they're not factoring in all the costs, capital gains, and all the rest of it. Like, any insight for any of the house flippers out there that are running this model?
Yeah, a lot of them out there, definitely. This is, I think, one of the most common questions that I get, and somehow there is this I'm gonna call it a bit of a misconception out there that is like, hey, Oscar, I heard that if I keep it for 1 year, then that's it, I'm good. I just keep it for 1 year and I
We're
sell
safe.
it, or I rent it for 1 year and then I'm okay with that. So yeah, in a way, the Income Tax Act does, like, especially with house flipping, they introduce new legislation, and it basically says if you sell a house that you purchase within 365 days, it's not going to qualify as capital gains, right? So and that is the reason people want to do this. They want to argue that they want to pay capital gains, which are now 25%, depending at the highest tax bracket, it will be
Yeah.
25%. But if this house flipping now is considered a business, now you pay in the top tax bracket,
Has
which
to.
now is going up to
Yeah.
like 53%, right? So I understand it's attractive. I understand the arguments from clients, and we always have the discussion. And what we're trying to do is to find ways to really make it so that we can argue that there is a capital gain and not business. However, for your clients out there and for everyone out there doing this house flipping, you really need to talk to an advisor, because this is not a black and white area. The CRA continues to make it a lot more difficult to grant you that capital gain tax, right? Even if you're gonna, like, so if you're going to build it and it's going to be your actual principal residence, then there is elections to file in there to make sure that the CRA is not going to then come back and basically say, no, you don't get this election. Um, so I know there is a lot of and the 300 going back to the 365-day type of thing. They be living there for a year or renting it for 1 year, right? So one of the things that really comes up and that we always remind clients, it comes down to intent, right? Because if your intent was to build this house and rent it, and it has to be shown with basically with paperwork, that's what you create that backup that you can later on say to Sierra, hey, I was building this house, my intent was to rent it, something happened with the market and I sold it, right? Or I had people live here. So
Well, I got maybe a trickier question. Maybe it's a straightforward answer though. Is if we translate house flipping to these individuals that are buying construction, new build rentals, and maybe they bought it 2, 3, 4, 5 years ago, they're now coming up for registration. Is it a reasonable argument to say I bought this 5 years ago, but I just want to get rid of it? And I don't know. Is it black and white? Maybe not. Like just I get a lot of that. I want to flip it,
yeah,
and
oh, absolutely.
like maybe they should wait. But can you argue that you've owned it and invested it over a few years? I don't know. Is that reasonable? What are you saying there?
Yeah, so again, that question comes up all the time for me, I'm sure for you as well, as you mentioned.
Yeah.
So with this thing, so those assignment flips, and they're called assignment flips, right? Like if you are assigning that property and and then you realize, okay, listen, I don't want it. I bought it to live in there, but I'm no longer gonna live in there. That one is very tough, and I can tell you, I've had a lot of clients with this same type of story, which it was actually true. Like I had a client, and then they bought this, they put a deposit in this house. The house took a long time, and then they ended up only getting it ready like 4 years down the road. But the time the client already had a kid with another one on the way. So then it's like I can't go back to that house because now that house is too small for me. So we have to go and make the argument about intent and about everything else. But honestly, they make it very hard on these assignment flips. So when a client, I mean, even with the argument that the house got too small for me and all this, because what happens is that in the meantime he bought another place, right? So now it's like, okay, we understand, but then you have your principal residence. Therefore, this original purchase was an investment, right? And because you didn't hold it, then now it becomes a flip, right? So that happens with the assignments, that happens with
Got it.
pre-construction homes as well.
A year. Yeah. Yeah.
That happens with land flips, for example, as well. So some people think, oh, maybe land will be okay. No, you buy land, and again, there is all these vacant home, vacant land taxes as well that are coming into place. So you really have to be careful with this. And even when we're talking about renovations, like the quick flip, right? Like that's the main one that always happens. But you do it quick, you turn it around, you sell it. Is not gonna work. And even
You're
wholesaling.
probably better off just refinancing it, taking out the money. It's correct me if I'm wrong. Tax free, refinance is tax free. You get that money. You might have to ride it out a little bit longer, but if you can avoid up to 50% tax it just makes sense to carry that cost and possibly even benefit from future appreciation, especially as in
Absolutely.
most of the big markets. I think we're not necessarily on a downward trajectory. We're on a sort of uphill trajectory, right? So,
Oh,
that's
absolutely.
it's just understanding those rules will go a
Yeah,
long
and
way.
a lot of the time, to be honest with you, a lot of the final discussion with the client is like, listen, it's just going to be better to hold on to this property. Let's
Yeah.
hold it. Let's put it like let's rent it out. Hopefully, it's cash flowing. And even if it's not, you're looking for the capital appreciation. And why would you want to pay 50% tax here, right? The
Even if it
the
costs you a little bit of money every month because it's not cash flowing, you might still be way better off just riding it out.
Correct, exactly. You want to write it out. Another option here could be, Hugo, as well. You consider if you're actually flipping houses, you go in there, you buy the land, you do the reno yourself, do everything. You get a couple of trades to do things, and then you sell it. Then that's now your business. Then another thing to consider is incorporating, right? Because now
Yeah.
with an incorporation, then you're paying the corporate tax rate, so you at least you don't get hit with that whole with the full score, in this case 53%, right? You're looking at a 12.5%, right? So the delta between the two makes it more attractive, especially if this is what you want to do, right? If you want to do it one time
Yeah.
and
Yeah.
out, perhaps don't go through that. But if you realize that, hey, this is my business, this is what I want to do, I'm just going to buy houses, rent, and sell, incorporation is something that you really need to think about, because the tax rates are then kept in check. assuming obviously that you don't need to take all that money out personally, right? Because I mean, we can get into a whole other discussion there, but as long as you want to leave it in the corporation.
Especially if you're looking to purchase maybe several rental properties, or you have the idea that you might want to do that from a financing perspective, even though it can be a little bit more difficult to get access to financing under a holdco structure, there's still a lot of options. And it actually might be more attractive to buy real estate in the holdco, because we're then able to scale your portfolio a little bit bigger, because it's being held in a corporation. There are some options out there that allow us to get into some lenders that otherwise wouldn't look at you if you have too many properties under your personal name. So there's some value there for sure. Just one last thing was for the investor clients. A lot of lenders right now are relying on the tax returns, the personal tax returns, to really understand what rental income you're reporting. Because historically, you have 1, 2, 3, 4 rental properties. As long as you have some leases and some bank statements, a lot of banks are okay with that, and some of them still are. But we're seeing a lot of lenders saying, "Hey, you've owned this property for 3, 4, 5 years. We don't really see much rental income, but you have all these leases and things." So for on the mortgage side, we're recommending clients, you got to be a little bit more transparent. You have to report all this stuff. Any insight or feedback for some of those investors in terms of what they should be doing on their those reportings, basically?
No, absolutely. And that's a very good point because I mean, historically, I mean, as with everyone else and with investing, because of the large taxes, people tend to perhaps put a little extra deductions in there from different places, let's call them. And so you're absolutely right. Like the banks are looking at this. I mean, obviously on your side of the business, and from my side, CRA has started to ask questions in terms of like, okay, hold on, same questions like you've held this asset for this long. Why is this not turning a profit just yet, right? And one of the key aspects here that and we mentioned before is the refinance, right? So CRA has come up with again commentary in terms of this refinancing because that's what they keep on seeing. People keep on refinancing, which is a great way. You keep on refinancing your property, you take the money, you invest somewhere else. But that is the key, though. Exactly. You need to take that money and invest it somewhere else. If you take that money and suddenly take, this vacation that you'll be planning for many years, well, that refinance is no longer deductible. And there's some room in here, but it's just I think it's important for people to understand that when they're refinancing their properties, if the money that's not going to another investment that they're also going to generate income from, CRA will come and start arguing that, okay, well, that's realistically is not, the interest is not deductible. So that's one of the areas that I've seen CRA really zone in when they come out and ask, hey, how come you haven't made any money? They realize there's been a couple of refis, and then they say, okay, show us what happened with that money. And if we can really have any backup to say, hey, we bought this other property for which I'm also doing investment income, or I put it into this business, or I put it here and I bought these other investments, then that's the issue, right? And with expenses, right? Like just be reasonable. Talk to your accountant. Discuss what's allowable, what's not allowable, right? Like meals and entertainment. If you're doing a rental property, it's gonna be a little tough. If you're saying, oh yeah, I have to take my tenants for dinner. Well, I don't know too many landlords that do that, but
hey, that's not a bad landlord right there.
Hey, sometimes, right?
I bought my tenants a car. They're really with COVID, the government had a lot of programs to get a lot of money out there to help a lot of people, but that also created a lot of debt on the government balance sheet. Are you finding that the CRA is really coming down? I almost feel like the CRA must have hired a lot more people or something, because I get the perception that the CRA is really coming down on people. They're really investigating anyone who's taking advantage of the system, and I guess they're trying to do this to recoup some of their money, make sure that they're able to get some revenues back in after a couple of years of printing. Like, does that make sense? Are you seeing more audits and things like that on the CRA in the last tax season?
Absolutely, and I mean we just went through the budget and we see the deficit that is projected, right? So we continue to see this huge deficit, 40 billion or around that. So they gotta look. They have to make that money from somewhere. Unfortunately, they're looking to do this, and one of the strategies a couple of years back, the government decided to put all this money. they allocated a fair amount of the budget into, okay, let's hire more CRA auditors, right? But then COVID also had the function that you couldn't really find people to do these jobs, right? So now they're going after every single little thing. And from what I've seen, they go for a lot of the low-hanging fruit. I mean, I'm just speculating here, just this is my own commentary.
Yeah.
To like to go for the low-hanging fruit because, like any other business, this crown corporation has a lot of people that are new, so they are not yet able to go after some of these more complicated transactions. So, hey, somebody that has a rental property, let's ask a little more. Hey, you have auto expenses, let's go. And this is stuff that CRA has gone after, right? CRA, travel expenses, meals and entertainment, donation receipts, like the basic stuff to look at what's going on with it. But absolutely. So if you like in the past you were kind of like aggressive and people were kind of like happy because they always have different people that advise them in different ways. So then when they talk to somebody that actually knows the income tax act, they're like, well, I've been doing this for years, nothing has happened to me. Well, it might be just a function that they weren't bothering to do this, but now they're definitely checking. I can tell you that at my firm, we basically have one person dedicated to dealing with audits now. It's just so many of them.
So
It used to
complicated.
be that we got every once in a while, and it was just they would check and then that's it. Now it's just they're checking after everybody, which again they're trying to recover some of these big expenditures that came out from the government to see now to try and figure out people that are not compliant and tax them and penalize them on it.
Right. Well, Oscar, I appreciate lots of insights here. I just kind of there's an ongoing theme in every response, and I think a lot of people sometimes look at their accountant as this is just something I have to do. It's an expense. That's kind of unfortunately sometimes the perception they have, but it's really the advisory that I think people should be looking at. A lot of the stuff that you're mentioning are things that maybe some people don't know and some people are not planning for. I can tell you with confidence that a lot of the clients I have, a lot of them are sophisticated. They're investors and business owners and so on. Their accounting, they don't really have any real relation with their accountant. In their mind, it's just I send my documents to this place, they take care of it, and it's done. But like the advisory, especially right now, with a lot of these assumptions people are making around house flipping and all these, should I buy in a holdco or not? A lot of these assumptions, which are completely different today, require real advice and real advisory. And I think that's where an area that I think sometimes is a little bit misunderstood and an area that you've always delivered for both us and our clients. So, I think it's important to remind clients that, hey, speak with an accountant, get an advisor, get a partner, build that relationship, that long-term relationship. So just like in the finance world, I want to know your goals over the next few years so I can build out a proper plan. You need that advice, that partnership on the accounting side to also build out the right advice in all matters of accounting, whether it's trying to manage your structures, plan for family trust, the worlds that you're always through this. So that's one thing I just wanted to plug, and always appreciate you guys. So appreciate your time, Oscar. Thanks again. I know you're extremely busy, and will continue to be busy, but always happy to have you here, and appreciate your time, man.
My pleasure, Hugo, and thank you for that comment. Yeah, I think as we deal with advice, we deal with clients all the time, and I think the relationship and really understanding clients and what the goals are is what's key, right? And a lot of people
Yeah.
a lot of people think about accountants, say, hey, just how do I increase my expenses and save tax? Well, we could do that, but we could also do really good planning and put you in a structure that your expenses are what they are, but you're saving taxes somewhere else. So I think that's
Yeah.
where the advisory comes in, and getting to know your client is important. And I will close just by saying, I'm sure your clients are looking at this. So today we got the news that the CRA is going on strike, right?
Yeah, I was
So,
actually saying yes.
but that's why I want to make a comment on that, because it so happens that they haven't made any comments as to the fact that they're going to extend the deadline. So we're still for April 30th. So I have to
Yeah.
remind my clients too, right? Like we need to
So
file by the
this isn't a
30th.
break. This isn't a break. But maybe if you're
Yeah.
going through an audit, maybe you'll have a little reprieve for a few weeks. But yeah, they're one thing you want to avoid is taking advantage of any taxes and mismanaging your accounting, because they'll eventually come back to you. Might not be immediately,
Exactly.
but so
Exactly.
have
We
the
we
right
like
partner and call Oscar and his team. So I
that.
appreciate it, man. Thank you so
Yeah,
much,
yeah, my
Oscar.
pleasure, Hugo.
Take care.
All
Thank
right.
you, man.
Thank you.